Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, May 6, 2015. I wanted to do a quick video here, just discuss a quick overview of the dollar, U.S. dollar, crude oil, and the energy sector. As most of you know, that's one of the sectors that I'm focusing on right now. So we'll start out by looking at the U.S. dollar daily chart. Now, this chart we're looking at here is from the post back on May 10th. You know, all the charts are time stamped. You can see it in the upper right hand corner. So this is the chart originally posted back on May 10th when I was calling for correction in the U.S. dollar, post titled Correction in the U.S. Dollar Imminent. And of course, the dollar, as we all know, did go on just shortly after that. Dollar topped, and we've had our, by far largest correction in years. And at the time, it was stated here, this is my minimum, as it says here, the trend line was a minimum price target. So we have, as of the other day, we've hit that trend line. I still expect a considerable reaction. Let's just take a look. Let's see if I can flip over to that chart real quick. Okay, I think we've got it in here, centered in the screen. Nope, gotta move it over a little bit. Bear with me. Okay, here we go. This is the updated U.S. dollar chart. So that's, back here on March 10th, that's where we were. The dollar started that sharp correction, had one thrust up, failed to make a new high, and boom, that's all she wrote. So, my initial pullback target was hit on this U.S. dollar chart. Keep in mind, this is from stockcharts.com, and as all U.S. dollar index charts are, they're end-of-day charts. The U.S. dollar index is the dollar against a basket of other currencies, the euro and the yen being by far the two largest weightings. So that's really what the dollar index is. That, and of course some other currencies out there with much smaller weightings. So point being that initial target's been hit. Near-term direction, as I've stated, a little unclear. This may be the final target. We may trade around this area on this trend line. Again, this doesn't reflect today's price action. The dollar index is trading lower. So if we're to close where we're trading right now, looking at UUP, we would probably close back under. We had a little bit of overshoot of that trend line here, you can see. And yesterday we closed above it or just right around on it, somewhere close to it. Back on that chart, this trend line was here. This would be my next downside target. We're also going to look at UUP if the dollar happens to slice and keep going through that level. But in trading, when you have these strong, very impulsive moves like this thrust down, once the dollar failed to make a new high, came back down very impulsively. The way I refer to that as is momentum. Is anything else. Trying to catch a football somebody throws at you very fast. You're not going to stop it immediately. You're going to have a little give back on your arms, and the same thing happens with stocks when they're coming down towards a key support level at a very fast velocity, such as this case. You tend to have these overshoots. They're pretty common. Whereas if a stock just drifts down low, it's likely to find support right on that trend line. So, and that works in reverse. Anything going up, fast, momentum will tend to carry it right through overhead resistance level, and you usually get those overshoots, and then prices come back down quickly. So where we go from here, we'll take a look at some of the charts in a second. I just wanted to mention here we're still struggling around that area, and there's some support if that trend line happens to not hold. We've already had a reaction off there for the last few days, so we're looking at somewhere around just over the 93.50 area on the dollar index as the next target. Interesting to note, we are oversold. We went from deeply overbought to oversold in very short order. So, you can look at this chart or any other chart. Typically, when you have these RSI readings of 30 or lower, like we just had, follow the crosshairs up, you see we typically have reactions. We became very oversold back here. Went under the 30 level, and then we had a nice rally for a couple months afterwards. So, from a trading perspective, if you weren't shorting the dollar up here, not objective, in my opinion, to short here. Very little downside potential, or I should say profit potential on the trade. But with the dollar being very stretched, very oversold, especially in the shorter term time frame, not an objective entry. So that's my take on the dollar. Okay, and quickly we'll take a look here at the the weekly chart. This was posted also back on March 10th. There's a timestamp up here in the center. So this was along with that other daily chart we just looked at. And at the time I had drawn my scenarios out here. We're up there. And ultimately, a final downside swing target should this be a more significant top in the dollar, not just a brief correction. I think we'd be going down here as I've drawn to about the, what is that? Looks like the 88 and change level. Some call it about 88, 88.50 or so. But there is also support there around 92.50 before we get there. Again, this was back on March 10th. As I mentioned, we were extremely overbought. The correction was made, the timing call was more based on the daily chart. This is a weekly chart. As I said, overbought can and often does become more overbought. So that in itself isn't a buy or sell signal. Rather, we use the daily and even 60-minute charts to hone down on those entries. Okay, now let's take a look at UUP. Again, this chart, trades in real time throughout the day. So it gives you sort of an idea. Now, as I mentioned before, we're on the USD index, what we were looking at on the stockcharts.com chart a second ago. We had prices struggling around. So this trend line came in a little bit lower. But again, this is today's action, this candlestick here, which is not reflected yet on that stock chart, which won't be updated until later today after the market close. But this trend line really comes off the same reaction points. And as I said, ETFs don't always do a perfect job of tracking indices or sectors that they're going after, but it's pretty close. Regardless, what we're looking at here, I've added this white line. Let me add the level here for that. That's roughly 2470-ish. I see horizontal support. We have this reaction here. We have this large breakaway gap, or at least a large impulsive candlestick after this consolidation range. So I consider this a pretty decent support level right here that the dollar's trading at now. And my expectation would be for a reaction either off this level. With this downside momentum, it's possible we take that out. Let's look over here at the volume of price histogram. We had this thin zone here. Now we have a pretty long bar. The length of this bar right here compared to this bar above it. The top of these bars, when you have these gaps, they'll often act as support. So I use that in conjunction with price support. So bottom line is a 2470-ish level where we're trading at or about now, right off the lows, is we'll call it a minor to moderate support level. And if that's taken out, which I would have to put about 50-50 odds, whether we have a decent reaction here, reversal in the dollar, or we go on and break through. And I'll get to that based on looking at the 60-minute chart here in a second. If that does give way, the next support level, if you've noted down here, I've marked this thin zone. The thin zone is where, as the volume of price histogram shows, very few trades occurred there. Thin zones work in effect a lot like a gap. A gap, you wouldn't have any volume if this was a gap, because that prices would have closed here and then opened up here. But it's the same net effect. Very few trades occurred at that point. And just like gaps, thin zones often act as support when retested from above. So this would be, and I'll go ahead and add that level here. I'm just roughly doing this. Let's see, 23. It's a little higher than that. So say 24. I'll call it 2437 or so right now. That's the top of the thin zone. And that is also, coincidentally or not, defined by this cluster of reactions here. If we look at right here, the price action, there's quite a few candlestick tags on the top there. So it's a nice horizontal support area as well as the top of that thin zone. So my expectation is if we do move lower, look for the dollar to find some decent support, probably at least a tradable reaction, meaning a bounce that's going to be measured in at least a couple percentage points and last for more than likely a couple days or more. If and when that level breaks, just like a gap, chances are if prices move well within this thin zone, we're looking at a backfill and probably move down towards the bottom of that thin zone, which comes in around 2370. So that's my take on the dollar. Again, not strong enough to really bet it. In fact, I've mentioned I don't often trade currencies. It's just not my cup of tea. If you trade them, you have to use a lot of leverage. Futures are the best way to go because the moves are, in percentage terms, so small. I prefer instead to track the currencies and use those to either confirm or refute my analysis, bullish or bearish, on dollar sensitive assets like gold stocks, oil, and energy stocks. Okay, now zooming down to a 60-minute chart of UUP. This, you can reference these on the sites. Remember, we have that symbol tagging system, so if you pull up the UUP or click on any of the tags, it'll bring up the old post. This was a chart that I've had up for a while. I pointed out this bullish falling wedge pattern in the breakout, and I expected that to be a bull trap. Expecting that breakout to fail. Normally a wedge breakout. This is if you look at the flagpole, if you will, the move coming up to that, looks like a large bullish falling wedge. At the minimum, we should have, as I pointed out at the time, this goes off the chart here. We would have been looking at, bulls were probably expecting a measured move up to about the 2050, 2040 area. Obviously, that didn't happen. Very few things in trading are more bullish or bearish than false or failed breakouts, because what happens is you have shorts tend to cover on the upside bullish breakout, longs tend to pile in, and when that breakout fell short, it didn't even reach the previous reaction highs. That was a very bearish technical event. It was pointed out back then, and you can see, look at the impulsive selling that comes in. So now where we're at is we have this sort of a steep falling wedge. The trend line is fairly well defined, not exceptional at this point. We might even draw another trend line. This might end up morphing into a less steep trend line, if I can use that word. I'll color that yellow just to differentiate it. But for now, this is what I'm watching, and we do have potential divergence here. It's a little bit sloppy. What I expect, I would like to see, we might come down here, but I would expect if we go lower to put in, as long as we put in a higher high on the MACD down here, so somewhere around this point, the MACD comes in, curls, and turns back up. The RSI, we do have potential divergence already forming on the MACD and the RSI. In other words, both of those are still at higher lows than they were back here. But just eyeballing this chart, it wouldn't surprise me to see the dollar move down lower to maybe that those support levels I just mentioned on the daily charts, and then put in some a little bit more clean, if I call them, bullish divergences, and then show a reversal. So that's my take on the dollar, where we might be going. It wouldn't shock me to see a reversal from here. As I mentioned, we are at support. We do have some potential divergence in place. Again, looking for a reversal either at or not far below current levels on the dollar. Okay, enough talking on the dollar, but again, where the dollar goes is almost certainly going to have an impact on where crude oil and hence, of course, the energy sector goes. This is a chart of USO. For those of you new to the site, I put up a pretty extensive post detailing why the end of in the drop in crude was near, citing Google terms, the intense bearishness, people calling for low oil prices years to come, and that was posted right here. Just before this, just right around the time of this first low, we went on to make a slightly lower low. Beautiful bullish price action I mentioned all along. We had numerous trades right off the bottom here in the energy sector and got out right towards the top. QEP, RIG, you can look at all those trades. They were most of those double-digit gainers. Came back to make another low. So again, I've reiterated all along, I remain longer-term bullish on crude oil. So that might surprise a lot of people. Well, why am I shorting the energy sector all of a sudden, especially in light of this recent breakout in USO? And as I've maintained, I believe this will probably prove to be a false breakout, i.e. a bull trap. Expect prices to reverse soon. Again, that's all covered in the static post on the site on USO as well as XLE and those, so we'll let that go. But that's my expectation, and this was my minimum downside target on USO, which is about the 1924, 1925 level. I think we'll come back to there. Also mentioned, it's not shown on this chart, I drew the potential for an inverse head and shoulders pattern. We'll have to change the neckline a little bit now to slightly upsloping, but this would be left shoulder ahead. And if we do come back in a little deeper than this level, we have the potential to put in a nice right shoulder. So I'll draw, it would look something like this, assuming we reverse soon. Um, let's see if I can screen draw this out a little better. We'd have a move down somewhere around here, a reversal, come back up, maybe have a little reaction there at the neckline, and then go on to break out of there and move a lot higher. Big thin zone on USO to be filled. As I've stated before, my minimum longer term upside target on USO is somewhere here around the 26.5 level. There's a bottom of a gap right there, which is almost a magnet to be filled if we get up in here and start filling this thin zone. And if prices clear that, we'll probably just move up to the top of the gap. And at that point, I would have probably lost interest in, USO. I would have, in other words, I try to capture the bulk of these initial moves, and from there it'll probably be sloppy sideways trading action going forward for the next few months. Again, that we're getting ahead of ourselves. That's something I'm, watching for longer term. But as a trader, I think at the very best, we're going to be dead money. I just looking at this chart, looking at the move that we've had off the bottom, going from oversold, we were down around the 30 level on the RSI, and we're already up to, just under the 70 level. So we went from being on the daily time frame oversold to overbought with really hardly even a pullback. So to see this pattern break out here and continue to run up to that level without a significant pullback, in my opinion, it would be extremely, extremely rare. We have some overhead resistance right up here, so I'm willing to allow crude to push a little bit higher. And as I mentioned, the good thing about being short the 3-time long energy sector ETF is, number one, if we just start trading sideways and have some sloppy action, that's going to work against my position being short the ERX. Of course, if we pull down, then that's all the better. So again, that's really just my take. Minimal upside here, maybe about the $22 level. Although I don't believe will be the case. But again, that's what I'm looking for on crude, is just another pullback here. At the very least, some sideways action just to work off these overbought conditions, and then give USO the gas or the umph, if you will, to make a solid and sustained breakout and run, up towards that $26.50, $28 level over time. Take a look at the 60-minute chart. Posted this quite a bit lately. This helps reaffirm my bearish take. This, along with the dollar, we have this very well-defined uptrend line. I drew this. I've been showing this rising wedge pattern over the last several days, last week or so, and I also, before it even happened, mentioned we might see an overthrow here, which we now have. So this is really, if you take a look at this light blue uptrend line, add it with this one, you can almost subtract this. I leave it on there just because I think it is still significant. Wedge overthrows are pretty powerful technical patterns, meaning when you have an upside break and prices move up like that, break above the wedge, in other words, this wedge here, the top, using this trend line, and then come back in. So once we see prices come back in and then especially break below, this will be the sell signal, whether we come back into the wedge or not. A break below this trend line, and then this horizontal line. This horizontal line here around, we'll call it roughly 2020 level, is this same top of that range. This is what crude oil bulls are looking at, this breakout. I mean, from just a simple price action point of view, beautiful breakout. Two gaps, look at that, gaps above those levels after we consolidated below and broke out. So in my book, should prices fall much below this 2020 level, in other words, fail to hold that breakout, you will probably see a tremendous amount of repositioning. Longs that jumped in on that breakout, realizing they were wrong, they're underwater, they sell, the shorts will pile in. So that's what I'm looking for. And, at the very least, like I said, a move down to about this level. And we do have the potential for this to really, for crude prices to tread water or move down lower, or at least trade sideways for maybe a couple months. And that's where the ERX trade could really shine. Okay, to wrap this video up, let's just take a look at XLE. Now, again, even though my preference was to short the ERX, which is a 3-time long, to try to capture some of that price decay. I also have some XLE puts. When tracking and trading, I never use those 3-time ETFs. I did post a chart of ERX when I first put the short up. But as far as timing entries and exits, I'll always use the 1-time ETF or the sector itself because of that very reason. As I said, over time the decay gives price distortion. So if you're looking at a chart spanning, a few months or more on a 3-time leverage ETF, especially in a volatile sector like energy stocks have been lately, you're going to see distortions. That chart, those trend lines you draw, are not going to be accurate because of those price distortions. So I always use the non-leveraged version. And here we see just a very nice uptrend line, rising wedge breakdown. I pointed out this morning, tried to get that post out before the open. It came out right afterwards. We had this initial pop in energy stocks. I mentioned that being a great time. Just an objective short entry. I didn't use the word a great time, but personally I added to my short position, and that happened to coincide with a back test. I mean, a perfect, look at that kiss back on that trend line. I haven't modified this trend line in days or more. So anyways, that's, nice technical action. We had the impulsive breakdown, back test, and prices have now, since moved sharply lower. These are some near-term downside targets for those of you trading XLE, or if you're trading short ERX or long ERY. Instead of trying to identify horizontal support levels on that chart, my preference is to cover when XLE hits support, because if you have a support level on ERX it's a little bit below, this is where the market's going to reverse more than likely. This is where the buyers will step in. So again, I use these charts for entry and exits even if I'm trading leveraged ETFs. So that's XLE. Nice 60-minute breakdown, negative divergences in place. I'm in textbook bearish rising wedge pattern. From a daily perspective, very similar. Obviously, the energy sector tracks crude oil prices, and just like USO, we've had a breakout, more of a weak limping through breakout. We had a couple spikes above, maybe a couple recent closes, and now we're back below there. So that, number one, is bearish for those people that are just focusing on the chart of XLE. Prices broke out, so took out the 200-day as well as this horizontal uptrend line, but now we've moved back below. So that in itself is a bull trap. A little bit early on when you get this, back and forth slicing action. I try not to read too much into it, or otherwise you're going to be whipsawed to death. Okay, we're above it today. Oh, no, we're below tomorrow. So when we've been slicing through a level, I don't put too much stock into it. I'm sort of taking a longer term picture and really trying to anticipate where this trade is going based on the case I've made. There is a gap. If should my entry, my short on the energy stocks be proved a little premature, there is a gap. A nice the top of the gap is right here. I should mark that line right around 85.12. But I don't think we're going to get up there. If my call on the market is correct, as I stated, regardless of what crude does, the energy stocks are most likely to get sold down with the broad market as the broad market comes under selling pressure. Same way you can see at times gold rally and the gold stocks get sold off despite gold prices rising, especially during impulsive selling in the market. So that's my take on the energy and the energy stocks and the US dollar. If you guys have any questions, feel free to use the contact form. And just be careful out there trading. We've seen a lot of volatility lately, especially when using leverage and things like that. I think the volatility is, if anything, is probably going to spike in the days to come here. So this has been Randy Finney with Right Side of the Chart. Hope you enjoyed.